We got a lot to talk about in this week's podcast. First of all, this guy Ned Davis comes on CNBC. He's predicting $660 gold. His call got a lot of press. I think it's a bunch of nonsense, and so I'll get into what I think Ned Davis is overlooking. Sure, gold had a rough week, finishing below $1,200, but I don't think the price is going to get cut in half. Charles Evans, Chicago Fed president, he talks about the Fed and basically admits, if you read between the lines, that it's impossible that the Fed can't raise interest rates. You got Alan Greenspan also coming on CNBC talking about why he believes the Federal Reserve is helping the economy to be moderately okay. That's the way he describes the economy, and he credits the Fed for it being moderately okay, and obviously without the Fed, I guess it would be worse than that. Remember, last week I talked about my FINRA arbitration, the one with my client who gave my former broker money to gamble with. Well, I got stung on that one, but wait till you hear another couple of firms put out of business, bankrupted, just in the last couple of weeks, or one of them in the last couple of weeks, by FINRA arbitrations. Again, more outrageous arbitration results that highlight the risks of running businesses in the United States, and in particular, being an employer in the United States, the most dangerous thing that you can do. We're going to talk about the Eurozone and their low inflation scare and how that impacted the currency markets. Everybody is talking about inflation not being high enough in Europe, that's all they need is more inflation. We're going to talk about the big collapse in Fannie and Freddie stock. Hey, I got to say, I told you so on that one, but we got a court ruling, which I actually agree with for a change. We're going to talk about what's going on with Fannie and Freddie. Also, we've got a lot of economic data to discuss, including, of course, the big jobs numbers that came out on Friday. We'll get behind the numbers, as I always do, because the headlines are reporting what a strong jobs report it was. But, of course, beneath the surface, once again, the data is actually weak. But we got a lot of economic data throughout the week and all of the market movements in the stock markets, currencies, gold, all that coming up in today's podcast. So sit back. We got a lot to discuss.
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories,
Your freedom.
the Peter Schiff Show.
Well, we got a lot, and that's probably an understatement, a lot of economic data that came out during the week. And so I'm going to discuss a lot of it. Most of the data was either outright bad or just worse than expected. But on Friday, we got the jobs report. And this is the big economic report of the month. And it has been for a long time. And it's the one that everybody kind of waits for. And you get the biggest market reactions to the jobs numbers, if they're a surprise. And apparently today's was. And I'll get into the market reactions and why I believe those reactions, again, are wrong-headed in another segment. But right now, I just want to focus on the data itself rather than the market's reaction to that data. And again, not just the jobs data, but all the other data that came out earlier in the week and some other data that came out on Friday that nobody really looked at because it was overshadowed by the jobs report. So let's start with the report. Before the number was released, there was a lot of anticipation that the number would be good. And in fact, those expectations seemed to be met. I mean, we didn't have a blowout report, but we did beat the consensus. The consensus was that 215,000 jobs would be created, and we ended up creating 248,000 jobs. That's better than what had been thought. I mean, it's not hitting the ball out of the park, but it's better than what was expected. The month before, August, which was initially reported as 142,000 jobs. And remember, most people thought that that was an aberration. Most of the pundits and everybody expected it to be revised above 200,000. And they were right in that it was upwardly revised, but they only revised it up to 180,000. Still better than the 142 that was first reported, but still not the 200,000 that people were looking for. If you actually average the 2 months, 180,000 and 248,000, the average is 214,000. I mean, that's kind of in line with the numbers that we were getting in the 6 months between February and July. In fact, it's below the average. In February, that was the first month that we really got above 200,000. And for 6 months, we were above 200,000 in every month except March, which was 192, so slightly below. But the average of those 6 strong months was 238,000 jobs a month. And the last 2 months, the average was 214. So to me, it shows that job growth is decelerating. And of course, that process will continue now that the Fed is doing less QE. It will continue even faster if they do no QE. And of course, it will fall off the charts completely and reverse if they ever got around to raising interest rates. The other number, though, that I think surprised people, more so than the jobs numbers, which I think, yes, it was better than estimates, but not that much, was the unemployment rate. Because there, pretty much everybody was looking for 6.1, right? That's where it was last month. They thought it would hold steady. Instead, it dropped down to 5.9. That, 5 handle is a big number, right? And we haven't had unemployment below 6% for all of President Obama's presidency. The last time it was below 6 was in mid-2008 before the financial crisis. And so this number kind of shocked people. And it made them think about what the Fed might do. And the Fed might tighten sooner rather than later. And that's really what lit a spark under the dollar. Although the dollar had been rallying, it just accelerated that ascent. It caused gold to go back below 1,200. It was down over $20. And again, I'm going to talk more about the markets later. Just want to focus on the data itself. But so the jobs numbers, the unemployment number, I think, was what really made the headlines and got people thinking, hey, this recovery must really be working if we got unemployment down to 5.9%. But again, if you actually look at the numbers are not good, right? Now, why do I say that? Well, first of all, you got to look at why the unemployment rate is down. Not just that it's down, but how did it get there? Because there's one way is that people find jobs, but another way is they stop looking and they leave the labor force, which again is what they did. The labor force participation rate dropped to a new 38-year low. Last month, it was at 62.8. That tied the previous low. This is a new low, 62.7. It has not been lower in 38 years. The number of Americans no longer in the labor force rose to a record 92.6 million people. 92.6 million people not paying income taxes because they don't have jobs, living on Social Security, welfare, who knows what government program. Somebody's got to support these people. And the army of the non-productive is growing by the month. This is not a sign of a real growing economy where people are leaving the labor force in droves. Also, real wages. Nobody talked about this, or real average earnings. The expectation was for an increase of 0.2%. Instead, there was no increase at all. They were flat. And so there is no wage growth. Now, prices are rising. Now, the government might not acknowledge how much they're rising, but at least they acknowledge that they're rising. But the fact that prices are rising at all and wages are not is a strain on the economy. And you have to also look at the 248,000 jobs and think about what kind of jobs are these? Are these good jobs? Are these high-paying jobs? Can people who got one of these 248,000 jobs, can they pay a mortgage with that salary? Can they support a family? Can they fund their retirement? Can they put money aside for their kids' college? Can they buy anything? I mean, what kind of purchasing power are these jobs? And if you look at the jobs, they are, predominantly low-paying jobs. They are not jobs that you can support a family on. You can barely support yourself. Most of these jobs, you have to live with somebody to be able to take them, right? Because you're going to have to be dependent on somebody. But these are waiters, waitresses, right? They're restaurant jobs, hotel, chambermaids, orderlies, valet parkers. You got jobs in healthcare, education, retail services, stock boys, cashiers. These are the kind of jobs that are being created, and a lot of temporary jobs and a lot of part-time jobs. Now, I also read that the vast majority of these 248,000 jobs, the vast majority, I mean like 90% of them on net, went to people 55 and older. 55 and older. And some of the people are way older than 55. They're 75. Why are people who you would think would be retired and enjoying their golden years, why are they getting jobs? It's because they need them. The economy is so lousy that people who had retired are now being forced out of retirement. They can no longer afford retirement because the cost of living is going up. They're getting nothing on their CDs. They now have to take a part-time job. Right? Now, if you're a wealthy retiree and you got a big stock portfolio, you probably don't have to get a job as a greeter at Walmart because you're benefiting from QE. But there are a lot of people who are paying the cost of QE, and now they're doing it with their labor because they've got to go back into the workforce. So this is what's going on. But another really important trend that people are not, talking about is the fact that a lot of these jobs are part-time, and a lot of people who used to have one full-time job now have two part-time jobs. And a lot of companies that used to employ a lot of full-time people now employ fewer full-time people, but a greater number of part-time people. Now, a lot of people are doing this to get out from under the requirements of Obamacare. And there are all sorts of other labor laws that are now kicking in where employers are incentivized to shrink their full-time workforce. And so as you are getting rid of full-time workers and you start hiring part-time workers, assuming you still require the same number of hours to be worked, you're going to have more part-time employees than you used to have full-time employees. And of course, if you're one of the guys, right, that lost a full-time job, if you're trying to replace your lost income and all you can get is a part-time job, there's a good chance you're going to get 2 or 3 of them, right, in order to make up what you lost. And so as a result, the net number of jobs is higher, right? But the quality is collapsing. And the quality of these jobs isn't factored into the jobs number. The jobs report doesn't care if the jobs are good, if they've got benefits, if they're high paying, if you can support a family. All they care about is it a job. A job is a job. So a part-time job as a fry cook at McDonald's is the same thing as getting hired as a software engineer at Microsoft. They don't care. But obviously, there is a big difference, not only for the individual getting the job, but for the economy. Because you don't really have a recovery that can support the kind of consumer spending that we need to keep the GDP growth going. But another factor here that is often overlooked is the fact that for years, right, a lot of people who could have taken low-paying jobs or part-time jobs did not do it. They chose not to take the jobs that were available. And why? Well, because they had unemployment benefits. They had extended unemployment benefits. And when the government is paying you not to work, that is a pretty big disincentive to work. Now, some of the people, right, maybe you lost a good job and now you're getting your unemployment, and all you're getting is, or all you're finding is really low-paying jobs. And you don't want those jobs. You want to hold out for a better job. The fact that you've got an unemployment check gives you a reason to hold out because you don't have to take the lousy job because you got an unemployment check, which may be just as valuable as the lousy job. Certainly when you factor in, commuting and other costs of having a job and the value of leisure. And plus, if you want more free time to keep looking for that better job, you're going to turn down the low-paying job. And then, of course, there were people who maybe lost one low-paying job and they didn't want another low-paying job. They'd rather just take a paid vacation. They wanted to take advantage of their unemployment benefits while they were there, right? They didn't want to leave something on the table. They wanted to exhaust their benefits before beginning their job search, right? So now that at the end of last year, when Congress did not extend the unemployment benefits, they ran out. for a lot of people. At the beginning, really at the end, December of last year and all throughout this year, 1 million, 2 million, maybe more Americans stopped getting their unemployment checks. So now what are they going to do? They've got no money coming in. Now they got to accept any job they can get, even a low-paying job that they were turning down in 2013. Now they're taking those jobs. And so a lot of these jobs that are being created are basically these unemployed people, either, now just accepting a low-paying job or finally taking one, and because the vacation is over, the unemployment gravy train is over. So that is not a sign that the economy is getting better, just because people are, finally giving up hope for a good job and taking a crappy job. And it also means that it's not sustainable, because eventually all the people who were voluntarily not working because they wanted to collect unemployment benefits, pretty soon all those people who do want to work will have jobs. And now where's the job growth going to come from? It's not, right? That's the answer to the question. So you've got all these part-time jobs. You've got older people taking these jobs because they can't stay retired. You've got people who can no longer collect unemployment being forced to collect a low-paying job. But all of this, all these people who would prefer to be retired but who are forced to work, or that would prefer to have a good job but are stuck in a lousy job, right? These people are not happy about their circumstances. That's why if you look at the polls where they poll people and ask them, how's the economy doing? And they say, horrible, bad. That's why. And you look at these, pundits on television, they think it's a big mystery. They're like, well, why? Where's this disconnect? How come the people think the economy is so bad when it's so great? Well, the answer is because the economy is not great. It only appears great if you look at the wrong numbers. But people who are living in the economy, who are experiencing it, who have these crappy jobs, who are dealing with a rising cost of living, for them, the economy is not so great. But, if you're one of these pundits who's a Wall Street guy, and you're making a lot of money, and you got a lot of stocks, and, you don't really notice what your housekeeper is paying for food, and nor do you really care because it's such a small part of your budget anyway, and you don't really care about your electric bills or things like that, then maybe things look pretty good. So your judgment is very clouded, right, when you're looking at things from a particular vantage point. But this jobs report was not good. Now, if the number would have been a big disappointment, right, then it would have even been worse. But it is not a sign of a strong economy. Averaging 214,000 jobs, it's really barely enough to keep the population, to take into account population growth. Meantime, we create 214,000 jobs on average over the last 2 months. That is, not a big acceleration of the pace. It continues the trend. In fact, it's actually less than the average of the 6 months previous. And again, I think that trend, that downward trend, is going to persist, and that we're going to get more and more numbers that come out south, not north of 200,000. And eventually, look, we're going to be below 100,000, especially if you actually look at what's going on in the economy beyond the jobs numbers. Because in many cases, too, some of these jobs reports are a bit of a lagging indicator because businesses are hiring people based on a false optimism of what the future holds. People are convinced that there's this big recovery that's coming, and so some companies are holding on to workers that they might let go of if they knew how bad things were going to be, and some companies are probably hiring people based on the fact that they are optimistic about a recovery. In fact, if you look at a lot of the inventories that have been building in a lot of companies, it's on anticipation that they'll be able to sell the merchandise. I don't think they will. I think they're going to have some heavy markdowns to get rid of it, and so they're not going to have the profits they anticipated, and they're not going to need the workers that they're either holding on to or that they just hired. So all this stuff is kind of like looking in the rearview mirror, but we have a lot more information that's been coming out this week that's bad. But meanwhile, if the economy really were good, right, the unemployment rate would actually be rising. Why would it be rising? Because the record numbers of people who have left the labor force would be coming back in. a good economy with lots of jobs, people would be returning to the workforce, and the unemployment rate would actually be going up. The fact that it's going down for the wrong reason. The same thing with average hourly earnings. They would not be flat because we have so many low-paying jobs, right? If the economy really were good, people would be quitting these low-paying jobs and taking the higher-paid jobs that a strong economy was producing. So we would be seeing an increase, big increases in hourly earnings, given the fact that they've been so depressed for so long, especially if you adjust them for inflation, right? But if we really had a strong economy, wages would be exploding because people would be getting rid of these low-paying, lousy jobs, and they would be getting higher-paying jobs. That's what would be going on. And maybe some of the people that have no jobs at all would take the low-paying jobs that they can't get now because so many more qualified people who should be making more money have had to settle for these low-paying jobs, and they displaced, workers who would normally take those jobs who are now just on unemployment. None of that stuff is happening. None of the stuff that you would really expect to see happening in a strong economy is happening. Now, also today, other numbers. What did we get out? We got the trade deficit, which again is still a deficit, $40 billion, $40.1 billion, pretty much in line with estimates. I mean, maybe a little bit better, slightly better. The prior month was $40.5 billion, but again, it's still $40 billion. You annualize that out, that's almost $500 billion, almost half a trillion in red ink flowing out of the U.S. economy. Where's the manufacturing renaissance everybody's talking about? Because you can't see it in the merchandise trade or the trade balance, because the trade balance is not getting any better. The ISM non-manufacturing index, that came out at 58.6, slightly below the forecast of 58.8, but a full point below where it was a month ago. I think it's now, that index is at a 4-month low. So ISM non-manufacturing, which is basically services, that is, dropped to a 4-month low. So that's not good news. But again, nobody really talked about that yesterday, or today rather. But look at yesterday. We got a lot of economic data points that came out on Thursday. Almost everything was bad. Start with factory orders that plunged by 10.1%. That was the biggest plunge ever. Now, granted, the prior month was the biggest rise ever, up 10.5. But we gave it all back, right? Any euphoria that they had last month. And I'm sure when the number came out, everybody thought it was great. Well, now the whole thing's been reversed, and it was a much bigger decline than people were looking for. So a huge drop in factory orders. Then look at the Bloomberg Consumer Comfort Index, right, which is another one of these measures. That came in down. Last month, it was 35.5. This month, 34.8. So consumers not as comfortable, despite the fact that, according to the government, more of them have jobs. Maybe one of the reasons that they're uncomfortable is because they got a lousy job. And now they're depressed because they had to throw in the towel and give up hope of getting a good job. And they accepted one of the crappy jobs that they were able to land. And let's see. What are economic indicators that came out? We did get challenger job cuts. That was a little bit on the positive side in that the number of announced layoffs was at the low in maybe 6 years, 5 or 6 years, about 30,477 announced layoffs versus 40,000 and change last month. But again, a lot of this is probably due to expectations that things are going to get better. And so companies are a little bit more reluctant to lay people off if they think the situation is going to get better. And I think they're wrong. And there's a lot of pent up, demand, if you want to call it that, or supply when companies start to let go of the workers that they've been hanging on to. But on Wednesday, we got the trifecta of negative data. Apart from the ADP jobs numbers, right, which was the precursor to the non-farm number, and that came out at 213,000, which was also slightly above the consensus estimate. But everything else was awful. PMI manufacturing index, right? That was 57.9 last month. They expected it to improve to 58. Instead, it went down to 57.5. So PMI manufacturing, disappointed. ISM manufacturing, bigger drop, down to 56.6 from 59 last month versus a 58 consensus estimate, 56.6. Big miss on ISM, and construction spending plunged, right? Down. They were expecting it to rise. And in fact, not only did it miss this month, but last month was revised down significantly. Last month, they had construction spending at up 1.8% month over month. They revised it to only up 1.2%. It was supposed to come in for this month at plus 0.5%. Instead, it dropped by 0.8%. So you've got big drops in construction spending. And again, this is consistent with all of the negative real estate data that we've been getting. And in fact, now the year-over-year consumption spending is now at 5% up versus last month it was at 8.2%. So you've decelerated from an 8.2% year-over-year annual rate of increase to 5%. How much longer before that becomes a negative number? Maybe not much longer. So lots of negative economic data that came out. Now look at Tuesday. More negative number. Case-Shiller, right? Big drop. Case-Shiller 20-city index. They revised the decline from last month from minus 0.2 to minus 0.3. This month, they were looking for plus 0.1. It came in at minus 0.5. Minus 0.5 is actually a big drop, 0.5% in 1 month. That's a big drop, right? 20-city index. And year over year, now the rate of increase is down from 8.1%, where it was at last month. It's all the way back down to 6.7%. That's a big drop in a single month. This is one of the biggest drops we've seen monthly in Case-Shiller. Again, really bad news when it comes to the housing market. Also, what do we get? We get Chicago PMI on Tuesday. That was supposed to be 62. Last month, it was 64.3. It came in at 60.5. Huge miss. 60.5, almost 4 points below where the index was the month before. So you've got all of this information coming out negative that the market is ignoring. Look at, this is consumer confidence. Another measure of consumer confidence dropped. It was at 92.4 last month. The consensus was a slight increase to 92.5, right? And instead, it came in all the way down to 86. Big drop in confidence. But wait a minute. All these jobs are being created. The unemployment rate is falling. Why is confidence going down? Right? So again, more negative information. On Monday, we got consumer income and spending. And here, consumer income was up 0.3, which was in line with estimate. Consumer spending, rather, was up 0.5, and the savings rate went down. So people are spending more and saving less. And again, if the economy really were strong, people would have extra money and they'd be able to boost their savings. Instead, they're having to eat into what meager savings they have left to make ends meet. So the numbers came in line with expectations, but they're not good numbers. The fact that spending is outstripping incomes and people are forced to cannibalize what little savings they have just to keep their economic heads above water, that is not good news. We also got pending home sales, which were below estimates. In fact, they revised the prior month down slightly, and this month was down again. And for the pending home sale index, right, they were expecting it to be plus 0.8. Instead, it was minus 1. Again, every time there is numbers released about housing, pretty much it's negative, right? I mean, all the numbers. We had that one outlier on new home sales. But other than that, all the numbers have been weak. And remember, housing is probably the most interest rate sensitive segment of the economy. And the Fed is threatening to raise interest rates. Everybody is so excited about these jobs numbers because they believe it means we're going to get higher interest rates. And that's what's strengthening the dollar and undermining gold and making people think that U.S. assets are the place to be. But if housing is already rolling over, if the air is coming out of the bubble now, and the Fed is still theoretically blowing air into it, they haven't stopped the QE. They're still doing it. The Fed is still buying mortgages every month, and the housing market is deflating anyway. Interest rates are still at zero, and housing prices are starting to fall. Inventories are starting to build. The buyers are running away, right? And the sellers, are coming into the market. And the Fed is still supporting the market, just not as much as it was before. How is the Fed going to become a headwind? That's what it's threatening to do. It's saying it's going to stop buying mortgages and then begin selling mortgages and raising interest rates at the same time, making it more expensive for people who can barely afford to buy homes now with record low interest rates. How much more difficult will it be to afford a home when interest rates aren't at record lows, when mortgages return to normal, which is what the Fed is saying everybody thinks is going to happen.
The Peter Schiff Show.
So the biggest, most significant market moves, I think, happened in the foreign exchange markets and the precious metals markets, although there was a lot of volatility in the stock market. I mean, a lot of days where the Dow was up or down 100, 200 points. It finished the week on a high note with the Dow up 208 points to finish just over 17,000. Not a new high for the year, but up on the day. Nasdaq up 45. Russell 2000 was looking very, very ugly at one point during the week. Apparently, people were talking about how technically it had made a death cross or something like that. But the Russell 2000, which managed an 8-point rally to close out the week, was still down on the week. And technically, that market still looks very, very toppy. And I still believe that the stock market is in the process of making a top and will, in fact, roll over if the Federal Reserve doesn't come out and take the rate hikes off the table and unveil another QE or reverse the taper. If Yellen does that before the market breaks down, then she'll avert the bear market. But if she waits until after it breaks down, then obviously she's going to be reacting to it. But either way, the markets are in the process of forming a top, at least a short-term top, until the Fed, gives in and gives the addicts what they need, whether they know they need it or not. And the more narrow the stock market index, the harder it is to see. So the Dow, closer to the highs. But if you look at the Nasdaq and then more broadly the Russell 2000, as you start to get more and more stocks, and it's interesting that the stocks that are the most dependent on just the U.S. economy. See, the Russell 2000 is more of a domestic play. S&P 500, Dow, a lot of multinationals in there. Not so in the Russell 2000. That's more skewed towards the U.S. And you would think that that would be the index that would be doing the best if the idea that, well, the whole world is a disaster and America is an island of prosperity, right, in a sea of despair, right? If we're the only game in town, why isn't the Russell 2000 the top performer? Right, because that's the one that's more of a pure play on the U.S., whereas the other markets are more global. And of course, those are the companies whose earnings are going to be impacted in the short run based on the strong dollar, because as they repatriate their export earnings, they're going to translate into fewer dollars. You don't have a lot of export earnings, or you probably don't have any export earnings really with most of these Russell 2000 companies, yet they are the ones that are suffering the most. So that's probably a good leading indicator of the deterioration in the U.S. economy. And of course, if the Fed does stop QE and raise rates, the U.S. economy can't do anything but deteriorate, which is part of the irony here, right? The reason that we had this big rally in the dollar, and it's been rallying now for weeks. In fact, I think this is the biggest string of gains, weekly gains for the dollar in years, maybe even decades. As far as consecutive weeks of dollar strength. And it started earlier in the week with all this nonsense about inflation being too low in Europe. And it ended with the nonsense of the Friday jobs number, and where we had the biggest dollar rally of the week and the biggest gold drop. I mean, gold was down better than $20. It closed back below 1,200. Gold is now negative on the year. And so are gold stocks. After a few months ago, they were the best performing segment in the market, and now they're negative on the year. They've lost all of their gains. I mean, they're not down a lot on the year because, remember, we were way down. We had a big rally, and then we gave it all back. So it's pretty flat on the year. But over the last couple of months, these are pretty big drops, considering we had a nice rally that we have now given up. But All of this based on the idea that the Fed is going to hike rates. And the reason is everybody is looking at the unemployment rate. Now they're looking at this 5.8% rate, and they're saying, well, the economy is improving faster than the Fed thought. Therefore, they might raise interest rates. I think Hilsenrath had a statement out today in his column that might have, fueled that fire by saying, oh, no, the Fed might raise rates earlier in 2015 than we thought, based on unemployment coming down. But if you actually even listen to what Janet Yellen said, it's not the unemployment rate that matters so much to her. It is the slack in the labor market. And based on this report, there's a lot of slack because more and more people are leaving the labor force. These are people who don't have jobs, but who could enter the labor force at any time if the job market improved. And so Janet Yellen always looks at inflation as a function of labor and wages. And she thinks that, well, if we have all these unemployed people that could come back to the labor market, it's like a shadow inventory. So that even though the unemployment rate officially is 5.8, she knows that unofficially it's much higher than that. In addition, the number I talked about, the earnings number being flat, again, that shows her, in her mind, that there's still no wage pressure. Even though the unemployment rate is 5.8%, there is no pressure on wages. So why would she risk raising rates when, as far as she's concerned, there's still lots of slack in the labor market and there's no inflation pressures, especially given the recent strength in the dollar? See, if dollar bulls thought that Yellen was going to raise rates, and so they went out and bought the dollar, because the dollar is now so much higher, that gives Janet Yellen fewer reasons to raise rates, because the stronger dollar has brought down commodity prices, it's brought down oil prices, therefore it's brought down gasoline prices, therefore it's diminished the inflation threat, and now given Janet Yellen another reason not to raise rates. So you see the irony? The dollar traders buy dollars because they think the Fed's going to raise rates, which would be good for the dollar, but because the dollar has gone up, the Fed no longer has to raise rates. The currency traders have done it for her. She gets, all the benefit of the rate hike without actually having to raise rates and have to deal with the damage of a rate hike. So the basically, by buying the dollar to profit from a rate hike, the rate hike that they're trying to profit from is less likely to actually occur. But of course, not only is it less likely, I don't think it's even possible. I think the probability is close to zero that it's going to occur. Because again, everybody is assuming things that are impossible to happen, right? Number one, they're saying that QE worked, right? They credit Janet Yellen and Ben Bernanke and the Federal Reserve. They're saying your QE policy worked, right? 0% interest rates for 5 years and quantitative easing rounds 1, 2, and 3. All of this worked. The economy finally is recovering. And because it worked, you don't have to do it anymore, right? You can stop the QEs. You can raise interest rates, and the recovery that you created based on QE and 0% interest rates, that can sustain itself without the 0% interest rates or the QE. It can't. It is impossible because the recovery was built entirely on that foundation of asset bubbles, on the wealth effect. In fact, that is what Yellen and Ben Bernanke claimed they were trying to do. They specifically said they wanted to build a recovery on the foundation of rising asset prices. And that is what they did. But that is the same faulty foundation that collapsed the last time. And it didn't withstand tightening before, and it's not going to withstand it now. Especially, and not only is Janet Yellen saying that she is going to stop QE, she's saying she's going to reverse it. She said that her plan is to reduce the balance sheet back down to where it was pre-crisis by the end of the decade. To do that, her balance sheet would have to shrink maybe by the equivalent of $50-60 billion a month. That's like reverse QE. How can the Fed do that? In fact, if you just look at a chart of the stock market and compare it to the Fed's balance sheet, it's pretty much the same chart. If the balance sheet shrinks, the stock market has to go down. If the balance sheet shrinks, the real estate market is going to go down a lot. If the Fed shrinks its balance sheet, we will be in the recession that the expansion of the balance sheet postponed. to a future date, and we'll be at that future if she tries to unwind these policies. See, it is the impossible unwind, right? They're all giving Janet Yellen credit for how successful QE has been, or the Fed in general. But the success cannot be measured until it's completed. You have to complete the exit for it to be a success. You can't claim success now because the easy part of QE is getting started. The hard part is ending, right? Just like it's easy to pick up a drug habit, right? It's easy to start smoking or, start doing drugs. That's the easy part. The hard part is quitting. Just ask any smoker. What's easier, to start smoking or to stop? So if somebody, is, smoking or a drug user, and they say, hey, I've signed up for a course to quit, and it starts next month, and so I'm already claiming that a victory and that it worked, you know not to believe them. You've got to actually do it. And it's easy to pretend that this stuff has worked when the hardest part hasn't been done. The exit, which I've always said from day one is impossible. And this is what we're going to find out, because I think the preponderance of data is going to continue to build, despite the fact that the traders want to ignore it. And they have been ignoring it. They ignored all the bad data that came out during the week. The dollar didn't really sell off. Gold didn't rally on the bad data. But gold sold off and the dollar rallied on the good data, what little good data there was. Right? So the markets only hear what they want to hear. They've got a scenario. They're going to run with it until something changes. But I tell you, from my perspective, having lived through the dot-com bubble, the housing bubble, periods of time where most of the people on Wall Street want to forget because they were, blinded by those bubbles. But I have a very astute memory for what was going on at that time. And I remember what it was like, and I remember how I felt, and I remember the frustration, knowing something and everybody else thinking the opposite of me. And, trying to warn people, going on television, giving my speeches. I remember the reactions, the things that people were saying, and it's the same now. In fact, it's worse. I would have to say that the irrational exuberance, the lack of understanding of the real problems, the failure to appreciate the severity of what's coming, right, I think is greater now than it was at any point while they were inflating the housing bubble or the dot-com bubble. I think what's happening now makes less sense. The problem should be more obvious, yet even more people are just as oblivious. So this is telling me that it is going to be really bad this next time around. And the need to be prepared is greater now than it's ever been. That you have your portfolio the right way, that you're in the right assets, the right currencies, that you take advantage, if you haven't yet, of the opportunity to buy gold and silver at these levels and maybe even lower levels. We'll see how much below 1,200 gold can fall. Silver now, what is it, 16, 17 bucks? I forget. I mean, it's well below 20 now. But these are opportunities. And again, I don't know when the irrationality is going to stop. I just know that the markets are irrational right now. And it can stay that way for a while longer. But as long as we're not using leverage, as long as we're buying things that we can afford and not overextending ourselves, it really doesn't matter if the markets go against us, if in the long run, we got the direction right. And eventually, the short-term losses, if the markets move against us, end up being long-term gains, which I'd rather have. I'd rather have a short-term loss and a long-term gain than a short-term gain but a long-term loss. Because that's what a lot of people are going to end up with. They think they're doing the right thing until it collapses out from under them. And I want to win the game at the end. I don't want to be ahead only to watch my winnings evaporate. Hey, and by the way, on the precious metals front, if you haven't heard the announcement, we did change the name officially now of my gold and silver company. It used to be called Euro Pacific Precious Metals, like my brokerage firm, Euro Pacific Capital. And that's really why I started the firm too, by the way. It's like, I had a lot of clients at Euro Pacific Capital that were buying gold through me. I was selling it through the Perth Mint, which was a program, and we still do that, where you keep your bullion stored in Australia, but we had a lot of customers who wanted physical delivery. And I used to just refer them to other firms. And then, I just said, well, find a dealer and buy some gold. But lots of people ended up getting ripped off. People were getting overcharged. They were getting a bait and switch. They were getting pushed into overpriced numismatics. So I set up my own metals company and just called it Euro Pacific Precious Metals. But, the business has kind of really developed on its own. And so decided to kind of rebrand it, make it kind of its own company, not make it sound like it's a, like a sister company or kind of like a division of Euro Pacific Capital. So the new name of the company is Schiff Gold. And the website has been redone to incorporate the new brand. So you might want to check it out, schiffgold.com. And you can talk to any of the metal salesmen there as well if you want to get some information. Now, the worst performing currency of the week is not a currency, it's a digital currency, Bitcoin. Bitcoin, I spoke about Bitcoin a couple of weeks ago on the podcast and mentioned its continued decline. We had breached the 400 level. The last time I spoke of it, I forget the low, maybe 380, 90-ish, something like that. And I thought that the market would continue lower, and that is in fact what has happened. In fact, on Sunday morning, we touched a low of $275 on the Bitcoin. That's down about 30% from where it was 2 weeks ago, although almost all the decline happened this week. It was pretty flat, I think, the following week, but the downtrend has resumed, with a vengeance. As I'm recording this, we're back above 300. We're around 310 or so, but there is considerable downward momentum in the price. Now, obviously, when you've dropped this far, this fast, again, as I said a couple of weeks ago, there could be a bounce, but I think that you continue to run into overhead resistance that is getting lower and lower and lower. And as I said a couple of weeks ago, I thought if we broke that we could go as low as 250. And I still think 275 isn't going to be the low for this move down. I still think probably 250, maybe as low as 220-ish or a bit lower, might be another short-term objective where you might find some buying, rather. I think 220-ish or so was around the high from mid-2013 before we had a substantial pullback and then ultimately went on a spectacular run in the latter part of 2013. So there might be some buying down there. But again, I don't really see any significant support in this market, and I still think we're headed quite a bit lower between now and the end of the year. There may be some bounces, but these are simply opportunities, in my opinion, to sell. I don't think the name of the game is to try to buy the dips in Bitcoin. There are some people talking about the fact that, well, it's a great bargain because now they're $300 and they used to be $1,100 or $1,200. $300 isn't cheap. Just remember that a couple of years ago, people were spending $5 or $10, and a few years back, they were pennies a piece. So from that perspective, $300 still looks awfully expensive to me, considering the price history of the digital currency. So don't get fooled into these artificial benchmarks into believing that you're getting a bargain because you're paying $300 for something that was $1,000. Just because some fool paid $1,000, it doesn't mean that it's smart to pay $300. I still think the price is high, and there's still a lot of people that have tremendous profits at $300 that want to protect them. But more importantly, too, you now have a lot of people, far more people, that have losses and that are looking to cut their losses, limit their losses. And I do think that the negatives, the big down move, as I said a couple of weeks ago, is going to be a big PR problem for the digital currency, not just Bitcoin, but for all digital currencies. And I think people are not going to be as excited about buying because if you've never bought and you've got all this downward momentum, I mean, there's nothing to say that your Bitcoin can't go from 300 to 200 or 100. So why take a chance? I know there are a lot of people that are holding and hoping, but I think the ability to get new people into the Bitcoin community is going to be difficult. What more people are likely to do is try to get rid of what Bitcoins they have, either by selling them or more likely spending them at one of the many merchants that now accepts them. And of course, all of that adds to the downward pressure as the merchants sell the Bitcoins as fast as they receive them.
The Peter Schiff Show.
The big market-moving story on the week coming out of the Eurozone, we got on Tuesday when the September inflation rate for the Eurozone was reported. And of course, it was reported as being bad news because it was the lowest annualized inflation rate in the Eurozone in 5 years. And this is supposed to be a bad thing. The inflation rate, as reported by the government, prices rose 0.3% between September 2013 and September 2014, 0.3%. And that follows a slightly higher increase in August of 0.4%. Now, of course, 0.3, 0.4, I mean, these are just guesstimates anyway. I mean, they don't know exactly how much prices are going up. Why the markets would react to 0.3 when if it was 0.4, it would have been okay somehow, but 0.3 was horrible because it was even lower than 0.4. And I'm reading in the Financial Times article, which was reporting on it. And part of the problem now is that inflation in the Eurozone has now been below 1% for 12 consecutive months. So they're saying that the poor people of Europe have had to endure 12 consecutive months where prices went up by less than 1%. Oh my God, how awful. I feel so badly for the Europeans that they've had to endure stable prices or prices that have only increased slightly. Wouldn't it be so much better if prices had just gone up by 2% or 2.5%? Apparently, that's what everybody thinks. I mean, we have all this unemployment in Europe and all these real problems, yet the one that everybody's most concerned about is that the cost of living is rising too slowly. And somehow, if they can only get the cost of living to rise faster. Now, first of all, the fact that this is the lowest inflation rate in 5 years shows that at no point during those 5 years did they have the dreaded deflation, right? If you're going to define deflation as falling prices, prices have never fallen. There has not been 1 year in the last 5 where prices have gone down. The closest they've come is only going up 0.4% during a year. Now, what is wrong with that? How is that a bad thing? How is that the reason that Europe is having all these problems? And somehow, if the central bank could just make inflation be 2% instead of 0.4%, that extra 1.6% difference, that's going to solve all Europeans' problems. If we can just make Europeans pay more money for stuff, then it's going to cure the unemployment problem, cure all the other problems that have been created by big government. Here, listen to more about, I'm reading from this Financial Times article, right? This decline, referring to the decline in inflation, is a setback for the ECB, which earlier this month launched a series of measures designed to boost growth and to start to move the inflation rate back towards its goal of just below 2%, right? So that's the goal, just below 2%. So they're trying to boost growth by boosting inflation. Well, you're not going to get more growth by creating inflation. In fact, if anything, you might restrain your growth by creating inflation. Here they write, it's too soon for these measures to have had an impact. But the further drop in the rate at which consumer prices are increasing underlies the severity of the threat. The severity of what threat? The threat that prices aren't rising fast enough? Now, apparently it gets worse because now they're looking at core prices too. Here, listen. However, there were signs that prices of other goods and services were starting to ease. Ease, meaning that's a bad sign. Eurostat said that the core rate of inflation, which strips out the volatile items such as food and energy, fell to a 0.7% increase in September from a 0.9% in August. And it says, in particular, the rate of inflation for services eased to 1.1 from 1.3, the lowest since May. So all this is bad news. The fact that core prices are rising more slowly than they were in August is bad news. The fact that Europeans only have to pay 1.1% more for services this year than last year, as opposed to 1.3%, which it was the prior month, this too is bad news. I mean, the whole thing should just boggle your mind that you have all of these serious problems in Europe. I mean, real problems. And the one thing everybody is focused on is a non-existent problem of deflation or a problem that inflation is too low. It can never be too low. The lower, the better. And falling prices are better than rising prices. This is all absurd. Now, of course, when the euro sold off, it was because the idea was, well, they don't have enough inflation, so the euro went down. And think about the irony there. Because the euro is not losing purchasing power, because it's holding on to more of its value, it lost value. So this is also the bizarro world of foreign exchange. It used to be that the lower your inflation rate was, the sounder and more desirable your currency was. After all, if you're going to hold a currency, you want to hold a currency that's holding its value. And the way you measure a currency's value is its purchasing power. So if prices are not rising in that currency, that's a good sign. And it used to be that countries that would come out with a low inflation number, that would be greeted favorably in the foreign exchange market. You would want to buy the currency. It was a high inflation rate that would be a negative for the currency, because who wants to own a currency that's being inflated away, right? You want to have a currency that's a stable store of value. And if prices are rising more slowly or not rising at all or even falling, that should be good. But in today's world where, black is white and white is black, because Europe announced lower inflation, the euro went down. Had they come up with more inflation, signifying that the euro was losing purchasing power, that would have been good news. If they would have come up with a bad number, or actually a good number, and in fact, when you look at the way they report inflation as better than expected or worse than expected, so they were expecting 0.4, and they got 0.3, and all the reports said the number was worse than expected. Worse because it was lower. This, again, is the Orwellian way they describe inflation. So when it comes to inflation, a higher number is better than a lower number. So if you're expecting 0.4% inflation, and you get 0.5, that's good news because the inflation was more than you thought. And if inflation is less than you thought, well, that's bad news, right? This is how they've redefined all these terms to try to make a bad thing a good thing and a good thing a bad thing. But the euro sold off because of the anticipation, well, this is bad news. The ECB is going to have to do even more QE. They're going to have to print even more money to try to cause more inflation. That they have a bigger problem now because inflation is even lower, and it's going to take even more money printing to get inflation up. Now, the thing is, though, of course, if inflation is 0.4, and their goal is to get it to 1.9, right? Because they want to be just below 2. And again, they just pull this number out of their butt somewhere. Some economist somehow divines that 1.9 is the ideal amount by which prices should rise to maximize economic growth and employment. But the difference between 1.9 and 0.4, right? It's what, 1.5%. And they're supposed to just open up the floodgates of euros and keep printing money just to try to get up to 1.9. Well, what if they get up to 3 or 4 or 5? I mean, what if they way overshoot? I mean, nobody even considers that as a risk, because then what would they have to do to bring the inflation rate back down? Right? How high might they have to jack up interest rates? And what if the economy is still weak and unemployment is still high, which will be the case? Because remember, the reason they want more inflation, or the reason they say they want more inflation, I mean, the real reason is different. But what they say is that we need inflation because that's going to grow the economy, because inflation is going to give companies pricing power. If they can raise prices, they can raise wages, they can hire more workers. When workers earn more money, they can buy more stuff. They think there's this, it sets off this self-sustaining loop of prosperity. It all begins with inflation. Like inflation is the spark that lights the growth fire, right? This is what they believe. But what if it doesn't happen? What if they get the inflation, but they don't get the economic growth and they don't get the jobs? And that's what I think is far more likely. I mean, there are plenty of countries that have high inflation and lots of unemployment and weak economic growth, right? I mean, that's more the norm, right? It's not that, it's the low inflation countries that are stagnating and the higher inflation countries that are succeeding. It's usually been the other way around. And in fact, the problems they have in Europe, and in fact, the problems that we have everywhere, the United States, Asia. It's all a function of too much government. I mean, why do they have all of this unemployment in the Eurozone? It is because of the laws that the government writes to protect workers. What they end up doing is punishing employers and creating disincentives to hire people. So the unemployment is a function of bad legislation, right? And it's a function of the moral hazards of the welfare state and all the things that governments do to undermine business formation, business creation, expansion, employment. None of this is a function of what the central banks are doing. It's all bad fiscal policy, bad regulatory policy, bad tax policy, right? And as long as the politicians can somehow punt it over to the central bank and say, well, the reason that we have high unemployment and sluggish growth is because there's not enough inflation, and they simply rely on the central banks to solve everything by printing more money, the actual problems are never going to be solved. In fact, the problems are going to get worse because there's no pressure on the politicians to do something about the high levels of unemployment or the sluggish growth. All the pressure is on the central banks to do something, and they can't do anything except print money and create inflation, which for some reason people think is going to help, even though it is going to hurt. And so now the central banks end up making the unemployment problem even worse. And now what is the solution? Well, I guess we need more inflation. They keep leaning on the central banks to print more money because the employment isn't coming. But the more inflation they create and the more the government continues the policies that are undermining growth and employment, the situation just gets worse. So instead of being a benevolence spiral, it's a vicious spiral where things keep getting worse. And eventually, these low inflation numbers are going to turn into very, very high inflation numbers. The problem is there is this lag. I mean, part of the problem is in the measuring, and we're not really measuring it accurately. But a lot of it is in the lag. And at some point, the inflation is going to be out of control, and it's going to be very, very difficult for the central bankers to rein it back in. They are literally playing with fire by trying to nudge the inflation rate up, and they're printing so much money to do it. And it's kind of like, an example of this lag, and you don't really know how long it's going to last, is the man in the shower. And, this is one of the things people ask me, what did you learn in college? And this is one of the only things I can remember, an analogy that I learned in UC Berkeley that I still think of today. And of course, my econ professor, I argue with him all the time. But this is one analogy that I still remembered that I think was viable, and it's called the man in the shower. And they said when central bankers try to fine-tune the economy, they often get it wrong, right? They're either too loose or too tight when they're trying to fine-tune. And the reason is because it's kind of like they said, a guy taking a shower. And everybody's had this experience. You get in a shower and the water is too cold. And so you turn the faucet towards hot and it's still cold. And you turn it a little bit more and it's still too cold. And you keep turning it, right? And it's still too cold, and you turn it, you turn it, you turn it. And then all of a sudden, it's scalding hot and you burn yourself. And now you got to quickly turn it the other way. And then it gets too cold again. And the reason for this is, what you expect when you turn that faucet towards the hot, you expect it to heat up. But it takes a while for it to work. So there's a lag between the time you turn up the heat on the faucet and by the time the water actually comes out warmer. But you're impatient, right? You turn it up and you want it to get hotter right away. And so you turn the knob and it doesn't get hotter, and so you turn it again. And it's not hot, you turn it again. You're impatient, you don't wait. Well, the Fed is doing the same thing, right? They're printing all this money. And it's not just the Fed, the ECB, the Bank of Japan, they create all this quantitative easing, they create all this money, and then there's not a big increase in prices. So they figure, we'll create some more. And then there's not a big increase in prices. Okay, let's create some more. Well, all of this money is eventually going to force prices up dramatically, especially when the velocity picks up of the money. But all of a sudden, it's too late. All of a sudden, you burn yourself because now all of this money printing that you didn't think was having an effect had an effect. It just took a while for the effect to show up. But by then, it's too late. Right now, you've got massive inflation that you've got to deal with. You've unleashed it. And how do you rein it back in? Well, now you're going to have to really jack up interest rates massively, much higher than they would have been, in order to bring it back in. And of course, if your unemployment rate is still high and your economy is still sluggish, and you thought that part of the reason was that interest rates were too high, which clearly they're not, because they're the lowest they've been in hundreds of years. I've made this point before. I mean, if low interest rates cured the problem, it would be cured. I mean, how could you say that interest rates are too high when they're at 300-year lows? But if you think that low interest rates are necessary to stimulate the economy, and all of a sudden you've got to jack them way up because you have to cure inflation, but you still have all the same other problems of unemployment. In fact, maybe they've gone worse. But the propaganda continues, the misunderstanding continues. They continue to report that they need more inflation in Europe. And that is what is actually fueling this dollar rally, is the idea that, well, the Europeans and also the Japanese are going to have to print so much money to get their inflation higher. But we're already there, right? We're already at the nirvana. We're already in the sweet spot because we're already at about 1.6 to 1.9. We're closer to that magic 2% number, right? So we can breathe a sigh of relief and we can start raising interest rates here in the United States because we have, the desirable amount of inflation. We have beaten the threat of deflation, but Europe and Japan, they're still in the crosshairs. I mean, they haven't dodged that bullet yet. They still have a lot of work to do to make sure their people don't suffer a stable cost of living or potentially a decline in the cost of living, even though nobody has yet to experience that. They've just had a slow increase. And so that is what is fueling these movements in the currency markets. But again, all of this is predicated on the fact that America is the one country that's not going to be in the QE party. And all that is wrong. I've said this many, many times. Nobody is connecting these dots, right? The dots between the fact that the U.S. economy is headed to recession. And we're talking about all the economic data that we had on the week, all the bad news that comes out, the market, the movements down in the market, all the signs that I can see point to recession. If the Fed stays the course, if the Fed continues to taper and then ultimately raises rates, and to the extent that the markets anticipate rate hikes are in the future, we will be in recession. The stock market will be in a bear market. Housing will be in a bear market. And under those scenarios, falling stocks, falling real estate, and recession, how is the Fed going to raise rates again? They're not. We already know what the Fed does when there's a recession or falling asset prices. They either lower interest rates if they can, which they can't because rates are already at zero. So they have one thing that they can do: quantitative easing. And if people think it's good for Europe and they think it's good for Japan, well, they're certainly going to think it's good for America. The only reason they think that we're not going to get more QE is because they don't think we're going to need it. Well, they're wrong. Of course we're going to need it, right? It's like thinking a drug addict doesn't need drugs to get high. Just because, we've been the biggest drug addict on the planet, that we can go cold turkey on QE, yet still act as if we were high on the stuff, even though we no longer get the fix. Well, any drug addict knows you can't get high without the drugs. You're not going to get a natural high that's going to give you the same euphoria as what you get from the drugs. So if you want that high, you can't go cold turkey. If you're going to go cold turkey, be prepared for withdrawal. Be prepared for rehab. Be prepared for a tough transition. But that's not going to happen in the United States. The politicians don't want that. The bankers don't want that. The voters don't think they want that. Everybody wants the quick fix. Everybody wants the feel-good economy. They want the shot in the arm. They want the wealth effect. They don't care about real economic growth. They'd rather have the phony stuff, as long as they get the phony stuff now. They don't want the pain now. So we know that we're going to get even more QE here than we're going to get in either Europe or Japan. But all the people that are jumping on these currency trades, that are buying up dollars, that are selling down gold. Obviously, the price of gold went way down too the day that this low inflation was announced in Europe and the dollar strengthened. But you would think if Europe is saying we're going to do all this QE, we're going to print all this money, that Europeans would be smart enough to want to buy gold. No, they're buying dollars. I mean, they're smart enough to realize that printing a bunch of euros is bad for the euro. So they want to buy, but then they buy dollars. But they don't realize that we're going to do the same thing. We're going to print a lot of dollars. So why buy dollars? Why jump out of the fire? Why jump out of the frying pan into the fire? They should have been buying gold. They will. Right? And the event that's going to cause them to change that is going to be when the Fed has to announce that it is reversing the taper. And either the market is going to wait for the Fed to come out and say it, or maybe the economic data is going to get so bad that it's going to be obvious that that's what the Fed is going to do.
The Peter Schiff Show.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro-Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff. We concentrate on those countries that are more closely in tune with Peter's vision of how capitalism is supposed to work. And these investments are not hard to find, provided you know where to look. Isn't it time you change the channel and let Euro-Pacific put a little reality back into your portfolio? If you live in the United States and have $25,000 or more to invest, call 800-727-7922. That's 800-727-7922. Non-U.S. residents access similar strategies through Euro-Pacific Bank at europacbank.com. Euro-Pacific Capital and Euro-Pacific Bank are affiliated companies.
The Peter Schiff Show.
So I'm listening to CNBC this week, and this guy Ned Davis comes on, and he has this bold call about the gold market, calling for gold to go to 660. And, his rationale for the call is based on cycle.
If you looked at the 1980s, peak to trough, you were looking at roughly a 65% decline. So you would take you in this cycle, 1900 was the peak 3 years ago, all the way to 660. And the one thing we do know is commodities run in big super cycles. So they eventually die. These cycles die. Gold does look like it's dying. So 660 is certainly in the cards.
So basically, right, the guy is saying that, well, in the 1980s, gold went all the way up, right, to 850, and then it had this big 20-year bear market. And so since gold had this huge run up to 1900, well, now we're going to have another 20-year bear market, just like the last one. And so gold's going to lose a lot of value like it did before, and it's going to go back down to 660. But what Ned Davis is not considering is, A, what is it that stopped the gold market from going up in 1980? It was the combination of Ronald Reagan and Paul Volcker. It was tight money. It was 20% interest rates. None of that is on the horizon now. We're not going to have that kind of tight monetary policy, and we're not going to have that kind of president. So the political and monetary conditions that put an end to the bull market in gold in the 70s, those conditions don't exist today. It's not possible given the amount of debt that we have. And of course, in 1980, the structure of the economy was a lot sounder because, it was still more of a viable. We still had a trade surplus in 1980. We still had a lot of our manufacturing sector going. The economy has deteriorated dramatically. We were the world's biggest creditor nation back in 1980. Now we're the biggest debtor. I mean, things had started to go downhill in 1980. They really started going downhill maybe in the 60s and 70s, but we're a lot further along in the process. Now we're completely broke. We're up to our eyeballs in debt. We've gutted our manufacturing sector. We're a shadow of our former self. So we cannot do what we did then. In fact, what we're going to do is likely to accelerate the gold price. But meanwhile, when he's saying that gold is going to go to 660, how is that even possible when you can't even mine gold for anywhere near? Most gold companies need $1,200 gold to break even. They can't even make a profit. How can the price go down to 660? If you think the price is going to go down to 660, you have to also believe that all the gold mines in the world are going to close down, and there's going to be no more gold production. And of course, if there's no more gold production, you would think that how is gold going to go to 660 if nobody is producing it? Unless, of course, people stop wanting it. You have to assume that jewelry demand collapses. Although why would that happen? Or whatever the industrial uses are for gold, that they're not there. They don't use it in dentistry anymore or aerospace, whatever it is, cell phones. Because none is going to be produced. So you would have to, this would be an unprecedented really decline. Because back in 1980, when the price of gold went down, the mines could still profitably mine it at 400. Back in 1985, 1990, 1995, gold mines were still profitable. They were still making money at those prices, those low prices. But if gold were to go to 660, unless, labor costs plunged, energy prices, all the other costs collapse, it's impossible for that to happen. But of course, what Ned Davis also overlooks is what about all the money that has been created? The Fed has expanded its balance sheet to $4.5 trillion. So in order for the gold price to go back down that low, the Fed would have to be able to get rid of that many dollars. It'd have to shrink its balance sheet back down to where it was when gold was 660. And that balance sheet was very, very small. How is the Fed going to do that, right, without unleashing another severe financial crisis and recession, which of course would spawn another round of QE and which would cause gold prices to go up? In fact, the only way that the price of gold can go that low is if the price of all assets collapse, because the Fed is raising interest rates and shrinking its balance sheet, and it doesn't care about the collateral damage or the consequences, right? It doesn't care if banks are failing and if the Treasury is defaulting on its debt. If that's the kind of Fed we have, then yeah, maybe that can happen in gold. But, the decline in the stock market will be worse. I think the decline in the real estate market will be worse. I think people will lose less money in gold than they will in other assets if the Fed did that. But of course, I don't think the Fed is going to do that. I think the Fed is going to launch a bigger round of QE than the one it just tapered. I think all the talk about rate hikes is just talk. Just like it was when they did QE1. QE1 was not supposed to be followed by QE2. It was supposed to be a one-time thing. It was supposed to work. The reason we had QE2 is because QE1 didn't work, which is why we had QE3, which is why we had Operation Twist. The Fed keeps doing this stuff because what it does doesn't work, so it does it again. And I don't think QE3 has worked any better than QE2 or QE1, which is why I know there's going to be a QE4. And obviously, Ned Davis doesn't know that, and so he thinks the price of gold is going to go down to 660. And of course, somebody else who knows that the Fed isn't going to raise rates, I think, is Charles Evans, who is currently the president of the Chicago Fed, who will be a voting member of the FOMC next year. I think Evans knows that the Fed ain't going to raise rates. He's not going to come right out and say so, but if you read between the lines, that's exactly what he is saying. He was interviewed by Steve Leisman on CNBC.
We're about to get to the end of our asset purchases, and now everybody's wondering what considerable period means. I think there will be, quite some time before it becomes appropriate to raise rates. And what I've been trying to mention in my commentary is I think that if you look at the risks, we ought to balance those and be concerned that sometimes coming out of the zero lower bound is a really difficult proposition for economies. And so I'd like to be patient in any removal of accommodation, make sure that we're very confident that the economy is strong and will continue to be strong.
So first of all, when Leisman is talking to him about the, this considerable period, right? I guess a considerable period between the time that QE ends and the first rate hike begins, still nobody wants to define it. So he says, yes, well, what does a considerable period mean? Well, it means quite some time. Well, what's quite some time? A considerable period. So you don't know, Leisman throws out there, well, what about June of next year? And he's like, well, yeah, maybe, but maybe a lot later than that.
June is certainly a possibility. My own view, once you say appropriate monetary policy, I'd be saying I want to make sure that we get inflation up to 2%. We might have to make sure we get it to 2% and a little bit above that, overshoot, just to make sure we have confidence that we get there. So a little longer than that would be appropriate policy in my viewpoint, but that's a committee decision.
First of all, when it comes down to inflation, he admits that it's not just 2% inflation that he wants. He's willing to overshoot, right? He's talking about symmetry. I want to be symmetrical. We can be above as much as we were below. And so we were running around 1%, right? That means that, he's fine with 3% inflation because if you average it out, it's 2. And 3% inflation, if you figure that right now it's about 1.5 to 2, and it actually got to 3, which is double the official 1.5, right? Well, can you imagine if the unofficial inflation rate were to double? I mean, we're living with a pretty significant annual increase in the cost of living, whether the government acknowledges it or not. And let's assume that if the official inflation rate were to double, that the unofficial inflation rate that we all live with would also double. So if you think the cost of living is going up now, imagine how you're going to feel when Evans gets his way and the cost of living is increasing at twice the current rate, or maybe more. So this guy, he wants to keep rates down because he wants more inflation. But the real reason, when Leisman asks him and says, look, if the economy really is so strong, 6.1% unemployment, and of course now we know it's 5.9, right? Because we got the more recent number. So now it's even stronger, supposedly, right? Leisman is like, hey, you've got you're responding to a 5-alarm fire. You got 0% rates. You're still doing QE, but the economy is in good shape. Look at the unemployment level. Why do we still have interest rates so low? Where's the emergency? And he's like, what, are you kidding me?
Sometimes I just think you have to be kidding me on this, right? Look at Europe. Look at the situation that they're facing. They're facing disinflationary risk. It's very low. They put the monetary union together and they're not able to hit their target. They're way below there. They're worried about the entire integration of that community. Look at Japan. They've had low interest rates and a bad economy, disinflation for 20 years. China's having its difficulties in terms of overheating and how they're going to generate growth without also bubbles appearing in the housing market. The U.S. economy is the strongest economy in the world right now. That's what everybody is looking for. Emerging markets also rely on everybody else doing very well. We need to make sure we've got the fundamentals right in order to have strong growth, get inflation up to 2%, so that we can exit the zero lower bound dilemmas that we have. Because if we stay in this environment for an extended period of time and then there were a downturn, we've used up all our best policy tools, and it's a tough slog from here on out.
Almost what he really wants to say is, don't you realize that the only reason that the economy is doing well is because of these low interest rates? Knucklehead, right? Maybe that's what he really wants to say. We can't take away these low interest rates. This whole thing is going to collapse. We got to keep them at zero. I mean, trying to say it's because we're the only strong economy left in the world and they're all dependent on us, that's nonsense. He's not worried about Japan or Europe. He's worried about America. It's not, he's making it if like, well, we can't raise rates here because, well, Japan and Europe are depending on our strong economy. We can't take a risk. The real reason he doesn't want to raise rates is he doesn't want to undermine our economy, our bubble economy. He doesn't want to take the air out of it. And he admits, he says, look, if we stay at 0% and we get a downturn, we have no ammunition, which is the box they're in. We've been at 0% for 5 years. We have no ammunition. He's saying we can't take a chance. He's saying that we got to make extra sure that this is a real recovery. Well, if they're not extra sure after 5 years, when will they ever be extra sure, right? They never will. They will never be sure enough to raise rates because the minute they start, this whole thing unravels. But he admits we can't risk tightening too soon and then having to reverse the process because we end up back in recession because we can't do anything because we're still too easy. We're not going to get rates high enough. See, if he thought he can get rates all the way back up to 4 or 5% before the next recession started, he wouldn't be as worried. He's worried they raise rates up to 0.5% or 0.25% maybe, and the whole thing implodes. And there's not much room to ease when you're still so low, right? That's really what he's saying. He's saying, look, we can't have a downturn. We can't risk a downturn. Well, if they can't risk one, they can never raise rates because the minute you raise rates, you're risking one. In fact, I think just by ending QE, right, they risk another downturn. And the longer they wait to raise rates, the greater the likelihood is that the economy turns down before they get around to it. And Leisman says, yes, it would be a bad thing to have to reverse the policy. It will be. That is one of the reasons that I was speculating that the Federal Reserve would not taper, because the untaper would do more damage than just continuing QE and pretending that the taper was going to come in the future. Because the minute they have to reverse ship, right, which they will have to do at some point, then I think it's a disaster. But I think what's going to buy the Fed some time is this huge dollar rally that we've had in the interim. this big sell-off of the price of gold, so that when the Fed does have to do the about face, the dollar has a long way to fall just to get back to where it was before it gets down to crisis mode, right? Because as long as it's trading within this range, right, as long as the dollar index is probably still north of 70, they've got some leeway. And now it's all the way back up to 86 and rising. Who knows how high it might get before the Fed has to admit the truth or before the traders figure out the truth. And so by then they bought themselves some time. But of course, all of this borrowed time ends up costing us dearly in that it ultimately exacerbates the size of the problem. But I think that Evans knows more about how vulnerable the economy is than he's letting on. But he is revealing what a big dove he is, what a big Keynesian and inflationist he is. And this is a guy who's going to be voting on FOMC. And it doesn't sound like a guy who's going to be voting to raise interest rates, yet people are buying up dollars on the anticipation that that is what's going to happen. Now, speaking of Federal Reserve officials, the former maestro himself, Alan Greenspan, the architect of the housing bubble, and I guess the father or the grandfather, if you want to call it, of the financial crisis, was on CNBC on Friday morning prior to the jobs numbers coming out, talking about the economy and the Fed, although really not being specific about what he thinks the Fed should be doing. Generally, these Fed chairmen don't like to opine on Fed policy once they're no longer the chairman. I guess they don't want to criticize or say something that might be different than what the current chairman is doing, some kind of Fed chairman etiquette, I guess. But he does talk in generalities. And he was asked about interest rates and the effect of low interest rates on the economy. And he basically says, yes, of course, low interest rates are going to cause stock prices and real estate prices to go up.
It's fundamental economics that when the real long-term interest rates are as low as they affect the capitalization ratios of stocks, real estate, even to a certain extent indirectly homes. So that when you get a very major decline in real long-term interest rates, it just proliferates through the whole overall financial sector more generally. And frankly, without that, we wouldn't have as at least moderately okay economy that now exists.
Moderately okay. I mean, is that redundant? I mean, do you need to say moderately and okay? Or is the chairman really revealing just how pathetic he believes the economy to be? Because if you describe it as, hey, how you doing? I'm moderately okay. I mean, that doesn't sound like you're doing too well. So if you describe the U.S. economy as being moderately okay, I don't know if there's anything to brag about. But here's the thing. If the economy is moderately okay with 0% interest rates and inflated stock prices and real estate prices, as Greenspan acknowledges, what will happen to this moderately okay economy if those low interest rates go away and the QE goes away? Well, I mean, if the best we can achieve with all this support, with all this money printing and bubbles, if the best we can achieve is an economy that's moderately okay, I mean, what's going to happen when the supports are pulled, right? Obviously, we know the thing's going to collapse. But meanwhile, Greenspan just admits, and he says, well, it's all okay. He says that on balance, I'm glad the Fed did this because at least now we have this moderately okay economy. If they hadn't done it, things would be worse, which is true, but they might already be getting better by now. But because they did do it, things are going to get a lot worse. Then he was asked about inequality. Right? And this is something, I guess, Joe Kernan, who's one of the other guys, talks about it once in a while. Not that many people on CNBC do, which, of course, because it's true, is that the QE is responsible for this big growth, this big gap. It's not solely responsible, but it's certainly a major factor in the widening divide between the rich and the poor, because quantitative easing, the inflation that they're creating, which is manifesting itself in asset bubbles, is benefiting some people, wealthy people, speculators, the owners of the assets, and it's undermining the job prospects and the standard of living for the vast majority of Americans, as well as increasing their cost of living. Because just like QE is making stock prices go up and real estate prices, It's making food prices and energy prices and things like that go up. And basically, when he's asked, is the Fed responsible for the inequality, he answers yes. He says,
well, basically that's true, but that's true all over the world.
I mean, that's basically it. It's an admission that the Fed is responsible. But then he goes on and says, well, but it's happening all over the world. Well, what difference does that make? Right? Just because other central banks are creating a gap between the rich and the poor by pursuing these policies, what does that have to do with what we're doing? I mean, he's basically saying, yes, the Fed is creating this problem, but other central banks are creating the same problem. So, why should we be concerned? I mean, that's not an excuse just because somebody else is doing it. It's like, the mother asked the kid, well, are you going to jump off a bridge just because everybody else is doing it? And say, well, yeah, no. And the thing is, we're doing it more than other people because I think the divide between the rich and the poor is growing faster here than in a lot of these other countries. But then he does talk about how the quantitative easing and the cheap money is benefiting the financial sector, but the non-financial sector, he says, is suffering.
What we've had is two fundamentally different types of economy. One, what is going on in the financial sector, and asset values have been rising pretty much around the world, whereas the non-financial sector has been struggling.
Which is true. We are diverting capital and resources from the productive part of the economy to the non-productive part, to the speculative part. And so we're not creating real wealth. We're not investing in plant and equipment, in machinery, and we're not creating good jobs, and we're not producing more products to increase the living standard of our people by increasing the abundance of products, right? That's not what's happening. But then he goes off on a tangent because first he starts off in the right direction by talking about the non-financial sector, and then he just says, well, it's structures.
The non-financial sector has been struggling largely because of the fact that a very significant part of the GDP, not only in the United States, but elsewhere as well, namely longer maturity assets, buildings mainly. Structures are down throughout the United States, both residential and non-residential. It's true in the Euro area, and it's true in many other places in the world, including Ukraine.
Commercial real estate isn't crashing. It's not necessarily that structures are going down in price. I mean, commercial real estate prices are still way up. What's happening is we're not investing in industrial infrastructure, in manufacturing. I mean, multifamily housing or office buildings for, even commercial space. Those building values are still elevated. They're still inflated based on the cheap money. They're still selling at ridiculously low cap rates. What he really should have said, or maybe meant to say, is that it's not, structures that are losing value. It is businesses. It is real assets in the real economy. That's who starve for credit. That's what we're not doing. We're not investing in plant and equipment. In fact, we're allowing the plant and equipment that we have to depreciate, and we're not replacing it. Companies aren't investing in modernizing their facilities. They're using the income that's generated from cheap money to buy back their shares. So the real pillars of the economy are crumbling beneath our feet. Meanwhile, we don't notice it because everybody is drunk on all the cheap money, just like they were when Alan Greenspan was the bartender, except now Janet Yellen is in charge of the bar, and she's getting everybody just as drunk, is not drunker. But, when you listen to Greenspan speak, every once in a while there's a kernel of truth that's buried beneath a blanket of lies and, all the BS because he doesn't want to indict himself. See, he can't really criticize Yellen or Bernanke without criticizing himself. And he wants to, of course, exonerate himself and pretend that he was in no way responsible for the problem. So he's got to pretty much excuse Bernanke and Yellen because if they're guilty, so is he.
Bernanke, your boy Alan Greenspan does the best that he can to walk away from this mess with clean hands. He cut interest rates to the floor and shit, supported the lending of subprime mortgages to people far too poor to
The Peter Schiff Show.
We on the surface sure it seems great, giving poor folks a road into real estate. But don't get comfortable, wait. The payments start to rise at adjustable rate. Lenders flip them like they hustle and wait and sell the debt from your apartment on foreign markets. This predatory mortgage started without the hint of a down payment. Flipping it sounds dangerous, and greedy investors flipping promissory notes on the hopes of future interest when the borrower was broke. This was the housing bubble. Now hundreds of thousands struggle to fight foreclosure, and moreover, the big banks take a spanking. They came from caked up to bankrupt tanking. Institutions the World Bank depends on gone like the companies WorldCom and Enron. Now here comes the crazy part. What is it? The Fed starts to bail them out days apart. Instead of folding them or scolding them, the U.S. government bank takes control of them. The same folks that insisted to keep the rates low on the interest and told the banks to go rape folks and pillage and make those millions.
Well, I don't know if it's a little early for the I told you so's on this one, but I still think I'm going to end up being completely vindicated on Fannie Mae and Freddie Mac. For those of you who have been listening to my radio show, the Peter Schiff Show, I had talked a few times about the spectacular rally in both of these companies, which basically are worthless. And they were delisted from the New York Stock Exchange. They trade on the pink sheets. And the shares were down at pennies. I mean, when they were publicly traded New York Stock Exchange stocks before the '08 financial crisis, Fannie Mae, Freddie Mac, I forget, they were $50, $60, $70 a share. And they basically crashed. And, you could have bought them for pennies a share. I forget what the exact low was, a nickel, a dime, whatever it was. But then they started to rise. And the hedge funds, several big hedge funds, started buying up all the shares. And Fannie Mae, I think, is the one, rose all the way up to a high of over $12 back in March. And I think Freddie Mac went up $6 or $7, something like that. I mean, both these stocks had big, big runs. And at the time, I was saying this is absurd. These stocks are not ever going to have value. They are worthless. And what happened was there were hedge funds that were buying them up because they were filing a lawsuit on behalf of the shareholders to say that what the government was doing with Fannie and Freddie was some kind of an unconstitutional taking of private property, because after the bailout, and the bailout cost the U.S. government close to $200 billion, right? So the companies would have gone completely bankrupt had it not been for the government. So the shares wouldn't even exist. But the government bailed them out, and part of the deal was that the government then owned the company. And the government was going to take the profits to help repay the bailout money. And now the new shareholders, it obviously didn't even own the company before it collapsed, but they bought it now for pennies or dollars a share. Their argument is that, wait a minute, this is onerous, this isn't fair. The profits have now, over the years, we've been able to pay back the bailout money. And so that now the profits should be flowing to the shareholders. And so they bought up all these shares, hoping that a court would declare what the U.S. government was doing illegal or unconstitutional and restore the private profits to Fannie and Freddie, restore them to the position that they were in prior to the 2008 financial crisis. And I always said that that was impossible, that would never happen. And what happened this week was that a court agreed, and they threw out the case and they said, no, it's not illegal. This is, the government can do this. And the shares plunged. They're not down at zero where they belong, but they basically got cut in half. Fannie Mae was at about 9 and change the day before the announcement, and then it fell down below 4, down about 3.5 on that day. Let me see. Freddie Mac, the other company, that one had a decline that was similar in magnitude, but it fell from a lower price. I'm bringing it up on my chart. Yeah, that one fell from like $3 down to $1. I guess percentage-wise, that's an even bigger decline. I mean, it snapped back a little bit off the lows, but the low was $1 the day after the court ruling came out, and it was at, well, no, it wasn't at $3. It was at $3 about a week ago, so I think it was at $2.50. But the high on that stock was $6. I mean, people paid $6 for those shares in March, $6, and they were trading as low as $1 earlier this week. Now, of course, people were buying them for 20 cents, 15 cents, 10 cents, whenever it was, when the stock was near the lows. But I still think these shares are going to go to zero. And here's why the court can never restore Fannie and Freddie back to the position that they were in before the 2008 financial crisis. Before the crisis, there was no explicit government guarantee behind Fannie and Freddie. It was called an implicit guarantee, meaning that when you bought securities, Fannie Mae or Freddie Mac securities, right? All the prospectuses said that these securities are not guaranteed by the U.S. government. So the government made it clear that when you buy obligations of Fannie and Freddie, that the government is not standing behind it. The taxpayer is not behind it. That it's not like buying a U.S. Treasury bond, right? Now, everybody always assumed that if something happened at Fannie and Freddie, that the government would step in, that they would never let these sponsored enterprises go bankrupt. And as it turned out, that was a good bet because they didn't. And if you remember, when I wrote my book, Crash Proof, and I forecast that Fannie and Freddie would go bankrupt, I wrote that back in 2006 when these stocks were still trading north of $50 a share. When I wrote the book, I said they're going to go bankrupt, but I don't know if the government's going to bail them out or not. They might just let the bondholders lose their money. I was hoping that they would do that, but I was afraid, and I wrote this in the book, that they would bail them out and they would honor this, implicit but not explicit guarantee. And that's ultimately what they did. But now the guarantee is no longer implicit. It is explicit. Everybody now knows that if you buy Fannie and Freddie insured debt, that the U.S. government guarantees it. Now, if that is the current case, how can you restore the profits to the private shareholders? Because then it's a situation where the investors, the owners, get all the profits and the taxpayers are guaranteed to get all the losses. That doesn't work. You can't have a business like that. I think they never should have had it the first place, the way they had it, because it exposed the taxpayer to massive liability. And there was huge moral hazards involved with this implicit guarantee. But now that they've made it explicit, the moral hazards are off the charts. So they can never do it. It was impossible. And the other thing that I said is, look, yes, Fannie and Freddie are making money today. They are making profits today. But are they going to have profits in 2015? I think if the Federal Reserve does what it's planning on doing, which I don't think it's going to do, but certainly if the Fed stops the QE, stops buying mortgages, and starts to raise interest rates next year, my guess is that real estate prices nationwide fall at least 10%, if not 20% on the year. Now, what is going to happen to all of these mortgages where people bought houses with 3% down? What's going to happen when the price of these houses goes down 10 or 20%? Well, we know what happens. Lots of defaults. People aren't going to pay their mortgages when they're deep underwater. We already know that, right? Now, I knew that was going to happen before the 2008 financial crisis. Other people still believed that people would pay their mortgages even if they were underwater. And I thought that was ridiculous to believe that, and I was right. And so we now know the people who didn't know it now. People are more likely to make their car payments than their house payments, especially when, if you stop making your house payments, you can still live in your house for 2 or 3 years. So the most important determinant of whether or not you make your mortgage payment is your equity position in the house. If it's still an asset, if you still think the house is valuable because you've got equity, you will protect that equity by making your mortgage payment. But if you're underwater, and if you're underwater substantially, then what is the incentive to give money to the bank? You might as well stop making your mortgage payment and just live there for a few years rent-free. And then, of course, you can also stop making your property tax payments. You can stop, paying your maintenance costs. You can just let your house run down a bit, knowing that you're not going to be there in the end. And, of course, all of these losses end up hitting Fannie and Freddie because when they finally, evict the deadbeat owner and the house has back property taxes and maintenance problems, all those costs reduced the value that the house can be sold for, which increased the losses to Fannie and Freddie, which therefore increased the losses to the U.S. taxpayers. So even if the courts were to restore the current profits to the shareholders, what happens a year from now or 2 years from now when there's huge losses? And now they don't have the capital again. So now they have another round of bailouts. They can't keep doing that. You can't keep giving the profits to the shareholders in the good years. And then when there's bad years, take the money from the U.S. taxpayers to bail out all the losses. Because any profits that Fannie makes or Freddie Mac make, they're not really profits. They're just down payments on future losses. That was always the case. It just took a long time initially for those losses to emerge. But the reason that they're making profits now is because they're underwriting more mortgages than ever on lower standards than ever, and you've got more government support. I mean, why is it that they're able to make so much money? It's because not only because of the now explicit government guarantee, which basically makes Fannie and Freddie debt like Treasury bonds. I mean, how can a private company, can any other private company issue U.S. Treasury bonds and basically borrow money and obligate the U.S. taxpayer? No. How can that be a private company? How can that company have the ability to issue treasuries? Only the Treasury should be able to issue treasuries, not a private company just borrowing money on the U.S. taxpayer. So the other reason that they can make so much money, apart from this explicit guarantee, which now means that their cost of capital is even lower than it was when the guarantee was just implicit, right? And it was untested, people didn't know, is the fact that the Fed has been doing all this QE. The Fed has been buying up all these mortgages, artificially inflating the value, supporting the market, which has enabled Fannie and Freddie to make more money. They've made a lot of money off this QE program, which is going to end. And in theory, anyway. And the Fed is also saying that it is going to start selling mortgages. If it wants to shrink its balance sheet back down to where it was pre-crisis, and it owns $1.7 trillion in mortgages. And in fact, Janet Yellen has said that she wants the Treasury's balance sheet, the Fed's balance sheet, to be back pretty much all treasuries and no mortgages. So the Fed has to get rid of all these mortgages one way or another. That is going to severely suppress the mortgage market. It's going to result in mortgage securities losing value, and it's going to result in big losses at Fannie Mae and Freddie Mac. And to try to force the government now to pay a huge dividend to these shareholders who just bought the stock on a complete gamble, thinking that they can railroad this through the courts. And maybe some of these hedge funds, maybe they thought that they can give money to politicians and get the politicians to support some kind of resurrection of Fannie and Freddie in a way that the hedge funds that own shares and maybe make these contributions would be given a windfall. This would have been a huge windfall profit to speculators who bought up these shares and somehow convinced the government to hand them a ton of money. Because whatever money these hedge funds would have made by collecting dividends on these phony profits at Fannie and Freddie that are only there as down payments on enormous future losses. At least now the taxpayers get the profits. Now, the profits aren't going to be big enough to compensate for the losses that are coming. So the taxpayers are still going to be big losers because of Fannie and Freddie. It's just that they would lose even more if these hedge funds were allowed to steal the profits during the good times, but stick the taxpayer with all the losses during the bad times. No, the taxpayers got to get the profits and the losses. Unfortunately, the losses are going to exceed the profits, so it's a bad deal for the taxpayer all around. It's just that if they had won on this lawsuit, and apparently they still have some more bites at the apple, they still got some more lawsuits, which is why these stocks are not at zero, because there's still some kind of slight probability. But I still think it's zero. I can't see any court basically returning these profits to the Fannie and Freddie shareholders. It would absolutely make no sense, especially now, given the new nature of these guarantees. But what really should be done, because some of the hedge fund guys are making a case that we need Fannie and Freddie for the housing market, and that's why they have to restore these companies to their viability. We don't need them. But certainly, the government has proved that they can be operated by the government not as for-profit entities. They can operate as government agencies, which in effect they are. So Fannie and Freddie are not really private companies. They're like government agencies, except the people that work there earn salaries that I think are much higher than what you can normally earn working for a government agency. So they probably, need to reduce the salaries that they pay the executives that are running the companies, their salaries and their bonuses. But obviously, they don't need to be private companies because they've been operating really as quasi-agencies ever since the government bailed them out. But what really needs to be done, if you want to advocate for the housing market, how about just wind them down completely? How about let's just get rid of Fannie Mae, get rid of Freddie Mac, let's get rid of the FHA, let's get rid of all government involvement. Why not try free market capitalism for a change? I know that may seem like a very, a big stretch in America to try the free market. But how about letting the free market allocate mortgage credit, right? Instead of government bureaucrats and government agencies and government guarantees. There's other credit. In general, the government doesn't guarantee auto loans, right? The government doesn't put a guarantee. If you go out and buy a car, your car loan is not government guaranteed. Your credit cards are not government guaranteed, right? American consumers go out and borrow money. Banks lend them money. There's no government guarantee on your credit card debt. Most, your lines of credit, a businessman goes out and borrows money. There's plenty of people borrowing money without the government involvement, and the market is able to ration the credit. It's able to discover the appropriate price. Why is it in housing? Why does a mortgage have to have a government guarantee? Why can't somebody borrow money to buy a house based on his own creditworthiness, not based on the federal government's creditworthiness? Why should one homeowner be able to obligate all the taxpayers to stand behind his mortgage? Why? Why do I, as a taxpayer, why do I have to be on the hook for somebody else's mortgage? Why can't I just be on the hook for my own mortgage? Or if I choose not to have a mortgage, if I choose to rent or to buy a house and pay all cash, and I don't want to have a mortgage, why should I have to be responsible for somebody else's? If you cannot afford your house, if you don't have the cash to buy a house, or you can't convince somebody to loan you the money based on your own creditworthiness, based on your own ability to repay the loan, then you shouldn't buy a house. See, what our current policy is that people who can't afford houses and who can't afford to convince somebody to loan them money because they don't have enough credit, or they can't put up a big enough down payment, or they don't have enough income to realistically be able to handle the commitment, right? People that wouldn't normally be able to buy houses are buying them now only because the government has said, you know what? We know that you don't want to lend to this guy because he really can't afford this house. So we'll co-sign the loan, make the loan anyway. Why should people be able to borrow money that they can't afford to repay? And of course, part of the problem is if the government wasn't there, right, real estate prices would have to fall because they couldn't find enough qualified buyers at the current price level without government guarantees. And that is the real reason that the government is guaranteeing mortgages, because they're trying to maintain inflated home prices. And that's the irony of the whole situation. Because why did the government start Fannie Mae and Freddie Mac in the first place? To make homes more affordable. But what is the current goal of Fannie and Freddie? To prop up real estate prices, to make houses more expensive than they would otherwise be if Fannie and Freddie did not exist. So it's now basically operating for the opposite purpose for which it was formed. Because the idea is to make houses expensive, not inexpensive. It's to make housing less affordable, not more affordable. If Fannie and Freddie get out of the way, real estate prices would come way down, and now people would be able to buy homes without a government guarantee because they wouldn't be as expensive. They wouldn't need as big a down payment. They wouldn't have to borrow as much money. The money they borrow, they might be able to afford based on their paychecks. And the lenders would be willing to make these loans because they would have more collateral and they would be smaller loans relative to the value of the property. In order to maintain these inflated home prices, in order to keep housing artificially expensive so that it's really prices are higher than what people can afford, the only way to do that is to have government guarantees, because the banks are not going to loan on inflated home values to buyers that can't afford them unless they have a government guarantee. Once you have a government guarantee, it doesn't matter whether or not you can afford it, because whether or not you can afford it is immaterial. Because if you can't, the government can. The taxpayer is on the hook to pay whatever you don't. And that is the problem. But who really benefits from propped up home prices? The banks. The banks that have already made loans on inflated home values, because they need to maintain the value of their loans on their books, and they have to pretend that the collateral is still there behind the loans. But some people think, well, won't it hurt homeowners if prices go down? Not really. I mean, if you own your home without a mortgage, I suppose it could hurt you. But if you have a big mortgage on your house, it's not going to matter. But also, what are you going to do? I mean, if you have a house and you sell the house and buy another house, the house you buy is going to be cheaper too, especially if you're planning on moving up. See, a lot of people don't even understand this. If I bought a house, one of these starter homes, right? If somebody buys a house and they buy a small house, smaller than they ideally want, and maybe it's 1,800 square foot house, 3 bedrooms, 2 baths, small, but they really want to buy a 5,000 square foot house with 5 bedrooms and, they want a bigger house. They want more land. And they start out with a smaller house. Well, if real estate prices go down, you're better off, because now that more expensive house, is more affordable for you. So if you're going to sell one house and buy another house, rising real estate prices don't help you. It only helps you if you're going to trade down. If you're retired and you want to sell an expensive house and buy a less expensive house, then falling real estate prices would affect you. But again, high real estate prices help the seller of a home, and only if he doesn't plan on buying a bigger home. But it doesn't help the buyer. What helps the buyer is low prices. But again, as I said, I just said, Fannie and Freddie were not instituted in theory to help the seller. They didn't bring these programs about so that people who own real estate can sell at a higher price. They were instituted theoretically so people who didn't own homes, to make it easier for those people to buy homes. But now the purpose of Fannie and Freddie is to make it easier for people who already have homes to sell them at high prices, and make it more difficult for people who don't have homes to buy them by jacking up the price and forcing them to go deep into debt to pay inflated prices for artificially puffed up real estate. When if Fannie and Freddie weren't there, the prices would collapse and the people who are now renting would get a great deal, and they would be able to afford homes. And people who bought small homes, who really want big homes, well, now buying a bigger home would be a lot easier, because it would be a lot more affordable, because the bigger home would be less costly. But again, this is how government works. Whatever they're trying to do, they end up achieving the opposite. So they're trying to make homes more affordable, they make them less affordable. And the only reason people can afford to buy all these overpriced homes is because they take on a mountain of debt. And the only reason they can even take on that mountain of debt is because the U.S. government guarantees that if they can't pay it back, which in many cases they can't, the taxpayer will, which again is why they can never restore Fannie and Freddie to their prior positions, because they never should have been created in the first place. It was a colossal mistake to have created them. What we really should do is get rid of them. But unfortunately, we don't have the political will to do that. So they're going to perpetuate in their quasi-corporate government agency form. And I think anybody who is speculating, anybody who is buying stock in these bankrupt entities, I believe they're going to lose 100% of their investment. It doesn't matter what you pay for the stock, whether you pay $5 a share, $4 a share, $2 a share, $1 a share, 50 cents a share. When it goes to zero, you've lost everything, right? And so, again, I can't give investment advice really on this podcast, but all I'm saying is I think that these companies are worthless, and that the people who are investing their money, I don't care how many court cases they file, and it would be a complete travesty of justice if they were able to influence the process through political patronage or through big donations to people in politics who might have some connections to try to, make a windfall. This would be a huge boondoggle. It would be a huge fleecing of the taxpayer if any of these temporary profits were siphoned off to the private shareholders of these companies, because again, it's only a down payment on enormous losses. And when the losses hit, it's not going to be the shareholders that are going to be left holding the bag. Once again, it'll be the U.S. taxpayer, or more likely, anybody that owns dollars, because the Fed is just going to have to print up all the money to bail everybody out.
pieces you left. Don't you worry about it. Don't you worry about
The Peter Schiff Show.
Try and give yourself some rest and let me worry about it. Let me worry about it.
On last week's podcast, I talked about the arbitration that we were recently involved in down in Florida at my brokerage firm, Europe Pacific Capital, where one of my clients, and again, I felt badly that, my client lost money, but I can't hold myself in any way responsible for this decision, even if one of my former employees was involved in it. And this, again, was a lawsuit where a broker who I fired a year later contacted one of the clients that he worked with while he was still working for me and convinced this guy to fund his gambling scheme on sports. He was betting on sports, and my client gave him $200,000 to gamble with. And, who knows what happened with the money, but my client only recovered $40,000 and lost $160, or he recovered $60 and lost $140. I forget exactly, but I got sued for the balance, plus punitive damages and all kinds of things. And the arbitrators said that I needed to pay him $40,000 of his losses. They don't give you an explanation. They don't say why or how they came to this conclusion. But somehow, because my client decided to gamble with my former broker, that I was responsible for $40,000 of their losses. Now, of course, had he successfully gambled, had he picked the winners, and I don't even know what he was gambling on, if it was horse racing or football or basketball games or whatever they were gambling on. But of course, had they successfully gambled the money, I wouldn't have gotten any of the profits. They would have kept all the profits, right? But because they lost, I'm responsible for $40,000 of the losses because the guy that convinced my client to gamble used to work for me a year before this happened. So, crazy decision, but I talked about it because it shows the incredible risks of running a business in America, particularly of hiring people. Hiring people in America is a very, very dangerous thing to do, especially if you're in the brokerage business. And the reason I want to talk about it again is because just in the last week, I read 2 articles about 2 FINRA arbitration decisions that came out that are, these are even worse than mine. Now, one of them involved a firm that was bankrupt. And there was an investor who ended up in a Ponzi scheme. He invested in something that turned out to be a Ponzi scheme. And he lost about $1.5 million and sued the brokerage firm. Now, the interesting thing about it is he didn't even make the investment with the brokerage firm he sued. He made it at the brokerage firm where his account was before he transferred to this firm. What happened was his original firm that sold him the investment that turned out to be a Ponzi scheme went out of business years earlier. And some of the principals, 2 of the principals from that business ended up joining this new firm with a third principal who had nothing to do with the earlier firm. And he was the president, and these 2 guys joined the firm. So their firm went bankrupt, so they went and they joined another firm. And some of the brokers from the old firm came over and joined them, which is what happens a lot in the securities industry. You know people, branch managers, some brokers work for you. You go to another firm, you recruit them over. So several of these guys moved over to this brand new firm. So the brand new firm had nothing to do with this investment. And they didn't buy the other brokerage firm. They didn't assume any liability. The other firm went bankrupt. So first, the court basically just decreed that this new firm was the successor to the old firm, and they assigned the liability to the new firm. But for what reason? Just because 2 of the principals are now principals of the new firm? That's unprecedented. There's no real precedent for that, but this is what they did. And then they were able to prevail on the suit. Well, the brokerage firm didn't have the money to pay the $1.6 million, so it went bankrupt. As is often the case in smaller firms, they get a big award, they don't have the money. You can't buy insurance for this stuff. I mean, they have insurance, but it's so expensive, it's prohibitively expensive, that most small firms couldn't even afford the premiums. And they have caps. And so generally, it doesn't even provide much protection, and it's extremely expensive, so it's not worth it. And so these small firms get sued and they don't have the money. So this firm went bankrupt. So now the guy sues again. But now he sues 3 of the principals, 3 of the control people or officers, one of which, the main guy, had nothing to do with the original firm where the guy made his investment. He sued and he won in arbitration. So now, and these guys that company's bankrupt. But now these guys personally need to pay $350,000 in damages each for the liabilities of the firm they used to work for that doesn't exist anymore. Crazy. I mean, first of all, it's a corporation. You would think that there's some kind of corporate veil. I mean, how can you go after these employees, and they were shareholders of a corporation, for the unpaid debts of a bankrupt corporation? Which should send chills down the spines of anybody in the securities industry if this is a precedent. Meaning that, if you're if you're the president or the treasurer or the CFO or the CEO, the chief compliance officer, if you're main guy at a firm, somehow you're liable for any losses. And then it got worse. Then I read about another story, and this one this one is horrible. And in fact, when you read the article, you don't get the whole thing. I went and I called one of the owners of the firm because they don't have all the stories. All the facts aren't, in the article. I read an article about it in Wall Street Journal. So there's a company, Resource Horizon Group is the name of the company. They were in business up until last week. They have about 250 brokers. And the way this firm works, very different than my company, Euro Pacific Capital. There are several firms like this, and I think most of them are going to go out of business, actually, because of things like this. But they have brokers who are generally self-sufficient. They have their own clientele already established, and they're very high payout type firms where the broker will get 90% of the commissions he generates. At a normal firm, at a big wirehouse firm, or at my firm, the brokers might get anywhere from 35 to 50% of the commissions, and then the other, the rest of it stays with the firm. But at these firms like Horizon that try to court independent brokers, they generally, get to earn 90% or so of the commissions, and they have to pay some fees and some costs. But a lot of times what will happen is brokers that have established books of clients will go out and seek out an independent firm. They don't want to work for a big wirehouse bank or something. They want to work for an independent firm. They have more freedom, they have less pressure, and they can get a higher payout. And so it's a lower margin business, but you make it up by having a lot of brokers. But you also end up having a lot of liability. All right, so this company with about 250 brokers, they're based out of Georgia. They've been in business for about 15 years. And if you look at their, very, very clean firm, hardly any, customer complaints or, just very, very solid, upstanding firm, from that respect. Well, about a year or two ago, it turned out that one of these 250 brokers was basically operating a Ponzi scheme. One of the 250. And he pled guilty. He was caught by the SEC, and he pled guilty. And he agreed that he owed, or he would have to repay, I think, $6 or $7 million of client money that he basically embezzled. Right? He stole. Now, of course, the guy doesn't have any money, and so the families, the individuals who lost their money, now sue the brokerage firm. And they just won a $3.9 million judgment against the brokerage firm, including $1 million of punitive damages. And that, of course, bankrupted the firm. Now, they not only did they sue the firm, but they sued the couple. There's a husband and wife that were the principals. They sued them personally. So not only is the firm bankrupt, but the individuals have to declare personal bankruptcy because apparently they don't have the $3.9 million either. So even though they own this brokerage firm, they're not very, very wealthy people. They can't write a $3.9 million check. So the company is bankrupt. Their people are going to be out of work. Of course, the brokers are going to go and hang their licenses at another firm. The brokers will be okay. The clients will move to another firm. But this company that these two people built up over the 15 years vanishes overnight. And somebody might say, well, it's their fault, right? They employed this guy. But it's really not their fault because I got the facts. First of all, the guy that they hired had been in a broker for a long time. And he started out with, I think, Edward Jones or somebody, and then he worked for a few other firms before they hired him. The clients that he brought over from other firms. He also was a lawyer, and he was a sports agent. So he kind of did three things. He was a sports agent, he was a lawyer, and then he was an investment advisor. And he had his license with this company. But the clients that lost their money were long-term relationships that existed long before this guy joined this brokerage firm. So it's not like they're working with this guy because he's at this brokerage firm. They're working with him because they trust him, because they're friendly with him, because they've known him for a long time. In fact, most of the people who lost money never even opened up brokerage accounts with Resource Horizon Group. In other words, they never filled out account forms. They never mailed any money to Resource Horizon Groups. Resource Horizon Groups had no idea that these individuals existed because they never actually opened up accounts. They wrote checks directly to the broker, not to the clearing firm or the brokerage firm. Now, the broker made up phony statements and gave it to the clients. But the statements didn't come from Resource Horizon. They came from the personal computer of this scam artist. When the original SEC investigation was done and the FINRA investigation, because as soon as this guy was caught, they investigated the firm because they want to find out, hey, is your supervision lax? So you're not doing all the things that you're supposed to do because maybe we're going to hit the firm with a failure to supervise or say you're responsible. So they got 2 audits. And both the SEC and FINRA came back and said that they did nothing wrong. The firm did nothing wrong. The same thing happened to me. I had a broker years ago, that ended up having customers send money directly to her, not to my brokerage firm, to her. And then she sent it to her own personal brokerage account in Hong Kong and began buying stocks in her own account and then was making up phony statements and sending them to my clients or her clients, my clients. I didn't know about it. She was doing all this from her house. I had no idea she was doing it, right? The only way we found out is that one of her clients or the firm's clients called up the firm like around New Year's Eve, wanted to get a quote wanted to get some balance off their statement or a quote on a stock. And they asked about a stock and we pulled it up and we said, well, you don't own that stock. It's not on your statement. And the guy said, yeah, I own it. And we said, well, fax us a copy of your statement because we don't see it on a statement. And then we found out that it was a phony statement. We immediately investigated it. We turned the broker in to the SEC, and we helped all the clients. They got all their money back. Not one client lost a nickel. Fortunately, the broker actually made money. She invested in these stocks. They went up. So we got all the money back. But it was complete. I mean, it could have been a disaster. I mean, if these stocks had gone down, I would have been responsible for all these losses. It would have been, it would have been a disaster for me because I didn't even have, I was a much smaller firm back then. This is going back probably to 2003 or 2004 when this happened. So fortunately, not a single client lost money, but I had no idea. And as soon as this happened, of course, I was investigated by the SEC and FINRA, and I had legal bills. I forget how much it was, $50,000, $100,000, defending I had lawyers because I had to show how I did nothing wrong. But at the end of the day, after the extensive investigation, they found that I didn't do anything wrong. That there's no way I could have known that she was doing this. And that's the same thing that the SEC and FINRA found with respect to Resource Horizon. They could not have known. It wasn't that their procedures were lax, that they weren't supervising this broker. They were. It's just that, you can't have hidden cameras in their houses. You can't, bug their phones, and you can't, wiretap the premises. You can't have a private detective follow them around. There's just a limit to how much personal privacy you can invade of your brokers to find out if they're, running a Ponzi scheme. But also, again, like in the case of my client, right? My client gave this guy money to gamble with. What were these people investing in, right? They were investing in promissory notes where the broker promised to pay the customers anywhere from 20 to 50% a year in interest, guaranteed returns. So a guy guarantees you a no-risk return of maybe 50% a year. Aren't you supposed to question that? Aren't you supposed to say, wait a minute, isn't that too good to be true? How can you get me 50%? They believed the broker. That was foolish for them to do that. It's not the brokerage firm's fault that these individuals were foolish enough to believe they can get a 50% return risk-free. And the brokerage firm had no idea that these clients existed because they didn't actually have accounts. There were a couple of people that had accounts with the brokerage firm. But again, if you've got an account with a brokerage firm and you just send a check to the broker, how do I know that? I don't, I have brokers. We don't have copies. Their banks don't send us their checking accounts. We don't know what's going on. And the regulatory agents basically said, you guys did nothing wrong. Yet the arbitrators said, well, you know what? You're responsible anyway because you hired this guy. Just because he was your employee, it's your fault. Even though the customers weren't even customers of the firm. They never opened up accounts. They never signed account docs. They never, the firm had no idea these people existed. Yet because this individual had his license with Resource Horizon, it's now Resource Horizon's fault. Now, one of the things they said as well, this guy had some disciplinary problems at Edward Jones, where he worked, right? He had some marks on his U5, for some customer complaint issues or things like that. And so they're saying you never should have hired him. But the bottom line is, I don't think the hiring had anything to do with their decision to invest because they knew this guy for 10 years before he got hired. They would have invested with him no matter where he worked. Plus, I talked to the woman who owned a firm. When they first hired this guy, they checked because FINRA had initially investigated him based on the U5, and they found that most of the things that he was alleged to have done, he really didn't do, and it wasn't his fault. Meanwhile, after he worked at that firm, he worked at 3 other firms before Resource Horizon hired him, and he didn't have a single complaint or issue with the other firms he worked at. And he didn't have any complaints during the time that he was there until they found out he was running a Ponzi scheme. In fact, I guess a lot of these clients, had no problem with him because they thought they were making all this money because he had all these bogus statements. Just like Bernie Madoff's clients. Were any of Bernie Madoff's clients complaining? No, why were they complaining? They were making a fortune as far as they were concerned. They didn't realize it didn't fall apart until the end. So I'm sure his clients were happy as clams, thinking they were making 20 to 50% a year. So why would they complain? Why would they call up, Resource Horizon and complain when they thought they were doing great? And Resource Horizon didn't even know there exists. But the bottom line is you have a firm. They got 250 brokers, or 249 are good, and you got one bad guy does something that there is no way that this company could have altered their compliance and stop this guy. The only thing that they could have done was not hire him, right? So the only mistake that they made was hiring this guy, and because they did that, they're now bankrupt because they hired somebody. They're broke. This guy is fine. He doesn't have any money. He's not in jail or anything, but these guys have lost their business, and a lot of other people have lost their jobs because a FINRA arbitration panel just says, well, he worked for you, therefore you need to write this check. And again, I'm looking at these FINRA arbitration boards as basically little bastions of socialism where they're really there not to dispense justice, but to redistribute wealth. And the idea is that the brokerage firm is always the rich guy that has too much money, and the customer, or in this cases, they're not even customers. They made loans to the broker. The brokerage firm never even got involved in most of these transactions. They had no idea they existed, got no commission, got no profit, right? But they're the guys that have too much money, and the individuals who file the lawsuits, they're the ones that are entitled to have wealth redistributed to them, right? Take from the haves and give to the have-nots. But in many cases, these brokerage firms are not owned by extremely wealthy people. In many cases, the people filing the lawsuits are wealthier than the people who own the firms. And probably in this case, I'm sure some of these families that lost money have a lot more net worth than the principals of this firm who are now bankrupt, even though they did nothing wrong. I mean, again, where is the personal responsibility? And why are we trying to impart so much liability on an employer? I mean, if the employer is negligent, if the employer really did overlook all these red flags. The article that I first read said, they overlooked red flags. And that was just what they alleged. But when I asked the lady, I said, what were the red flags that you overlooked? She says, there were none. I said, what did they bring up? They didn't bring up anything. The only thing they brought up was the U5. And they said that the firm should have shown the customers the U5. And I said, well, how are you supposed to show people the U5 when you don't even know they exist? Right? They're not even customers. Meanwhile, we don't send out copies of the U5s of all of our brokers to all of our customers. Look, they're there. If anybody wants to research a broker, they can go online, go to Brokerage. There's all this information, and you can get your entire employment and disciplinary history. It's all online. But the brokerage firms don't go out of their way to just send all this information to every client. If the client is interested, he can go look for it. None of these clients ever tried to look for it. They take no responsibility for their own actions. They don't take responsibility for the fact that they didn't bother to do their own due diligence on the broker that they hired, which had nothing to do with Resource Horizon Group. They had never heard of Resource Horizon Group. They only knew the broker. They did no due diligence on their own guy. They did no due diligence on their own investment. I mean, common sense would tell you can't make a 50% return every year guaranteed. Common sense would tell you that there's something wrong. It's got to be too good to be true. So, but they don't do any due diligence, and somehow it's the fault of the couple that owned Resource Horizon Group. And so they're broke. I mean, we have to take personal responsibility, and we can't hold employers responsible for everything bad that happens simply because they make the mistake of hiring people. Because don't we want employers to create jobs? Don't we want companies to hire people? Well, if we do, we can't saddle them with all this liability, because all these awards say is don't hire people. And, and because of all these rulings that have come out, I know the things that we've altered. I mean, we won't hire any brokers that have ever been fired. Ever. You can't do it because they use it against you. If they've ever been fired for a job, that can be used against you. Okay, so sorry. We can't, don't want to hire relatives. I can't let people work from home anymore. I used to let brokers work from home. I can't do that. Well, you know what? What about somebody who's disabled? Maybe there's a guy in a wheelchair and look, I can't go to the office, but I can work from home. Sorry, I can't let you. I'd love to have you work from home, but it's too much liability because I can get sued easier if you're working from home. We used to have a few brokers that work for home. It worked for me. It worked for the clients. But the government said, too much liability. You got to fire those people. You can't let people work from home. You can't let people telecommute. They have to come into the office because you have to be able to prove that you're supervising them, even though, of course, you can't supervise them 24/7. Nobody knows what a broker does in his free time from his house, from his cell phone, from his home phone. You can't do it. I mean, brokers have a certain degree of personal privacy that you can't invade. And somehow they're holding you responsible for things that you couldn't have done. Now, in theory, when they write these rules, right, they write it in a way where it has to be egregious. You have to be able to show that the brokerage firm really was negligent. But now they make these awards even when there's no evidence. And really what really makes me mad is that the brokerage firm, even though they had the FINRA and the SEC investigated them, and they both exonerated them, they are not allowed to admit as evidence in the arbitration those audits and those results. They're not allowed to do it. So if you have the government regulators that say good things about you, the brokerage firm is not allowed to admit that as evidence. But anything bad that's ever written up about the brokerage firm, the plaintiff is allowed to admit that. Right? So if the SEC says something bad about the firm or FINRA, then that can go into evidence. But if they say something good, that's barred from going into evidence. That's how the proceedings work. So the deck is stacked, and more firms are just going out of business left and right. And eventually all that's going to be left is going to be these huge, giant mega firms, too big to fail firms, because the laws and the courts and the lawyers will drive all the small independent firms out of business. And ultimately, a lot of jobs will be lost and fewer people will be employers. And this is just the one industry, because I know there are people who employ people in other industries that also face this. I mean, I don't know because, this is the industry I operate in. But there are employers all around the country who are being held responsible for things that employees do that is totally beyond their control. And all of this is the added risk, the extra punishment that is leveled on you if you make the mistake of hiring somebody. And that, again, is all that this couple was guilty of. They made the mistake of hiring a bad apple, even though they had no way of knowing at the time they hired him that the apple was bad. I mean, you have 250 brokers. Isn't there a chance that one of them may be bad? And if it is, the whole company collapses. And how are you supposed to know which one is going to go bad? Maybe what you do is you don't hire anybody. The only way to make sure that you don't hire any bad employees is not to hire any. That's it for today's podcast. I hope you're enjoying it. I hope you are sharing it with your friends. Don't forget to like us on Facebook, to subscribe to our YouTube channel, follow me on Twitter, and help me spread the word about the Peter Schiff Show in podcast format so we get more people listening on a weekly basis to 2 hours of economic sanity in what is really an insane world.